All right, Walter Wofford back. We're working on the short-term rental cash flow roadmap, and we're making progress. So we've looked at a digital banking platform, step one. Step two is learning how to buy houses with seller financing. Number three, how to do a joint venture for your short-term rentals. We then added the Inherited Roth IRA piece, very important if you want to create some tax-free money today. And so in this video, we're combining a joint venture with an Inherited Roth IRA and looking at all the various angles of how you can scale your business as a joint venture tax-free. All right, I got help from my AI assistants, and they'll tell you more about it in just a moment.
So if you'd like a copy of my ebook entitled Profit Powered Hostings, How to Run a Short-Term Rental Business Using RelayFi, just pull out your camera and put it up to the QR code and enter your information, and you'll immediately receive the ebook. All right, thank you.
Yeah, and today we've got a really interesting one you shared. It's about using an inherited Roth IRA.
Right, and putting it into a short-term rental, an STR property, but as part of a joint venture LLC.
Exactly. It touches on so many complex areas, retirement accounts meeting real estate, partnership structures.
And crucially, how you eventually get assets out of that IRA wrapper. That seems to be the focus here.
It is. So our mission today is really to unpack the specific JV setup you've described.
Understand how these inherited Roth IRAs work. They're a bit different.
Definitely. And get clear on the timing rules. Those are critical. And then look at the options for, getting the assets or the money out tax efficiently.
Okay, let's get into it. There are definitely some twists in the details here.
For sure. Okay, so the setup you laid out. 2 partners, scaling up an STR business.
And the plan involves buying a property, furnishing it, total cost projected around $150,000.
Right, and the funding is where it gets interesting immediately. It's not split down the middle.
Yeah, you've got the inherited Roth IRA putting in just $5,000.
And the other partner, who's not using IRA funds, is putting in the bulk $145,000.
Big difference there. But the LLC ownership, you said, kind of reflects that cash contribution.
Yeah, roughly. The IRA gets about 3.33% ownership, and the non-IRA partner gets 96.67% based purely on the capital in.
Okay, that makes sense initially. But then there's a twist in the agreement itself.
Yes, and this is important. Despite the unequal ownership based on capital, the written agreement states that the net income from the STR operation,
like the actual profits each month.
Exactly. That net income gets split 50-50 between the 2 partners.
Okay. So equal share of the profits despite very unequal initial investment and ownership percentage? Interesting.
And there's more planning ahead in the agreement. They specifically plan to take an in-kind distribution after 10 years.
Meaning taking the actual asset or the IRA's share of the LLC interest out of the IRA.
Precisely. Planning for that exit is key here.
And what if they just sell the property after 10 years instead?
The agreement covers that too. Net sales proceeds are split 25% to the IRA partner, 75% to the non-IRA partner.
Okay, different splits again.
Yeah, and there's a condition. The non-IRA partner is supposed to get at least their initial $145,000 back first from those proceeds.
Got it. And the income projections you shared, $5,000 a month gross from the STR.
Roughly, yeah. Then about $1,500 in monthly expenses, taxes, utilities, insurance, cleaning, the usual stuff.
Leaving $3,500 net income per month.
And based on that 50-50 income split agreement, that's $7,750 a month earmarked for each partner, including the IRA.
Okay. And just to be super clear, this whole discussion is about an asset the inherited Roth IRA invested in, not just inheriting, say, a house directly outside an IRA.
Absolutely critical distinction. The rules for assets inside an IRA, especially a Roth IRA, are completely different when it comes to inheritance and distribution.
Right. So let's dive into those rules. Because the basis, the taxation, especially for taking that asset out in kind, that sounds like where the real complexity lies.
It really is. So starting with Roth basics. You put in after-tax money.
So contributions always come out tax-free.
Always. But the earnings, they're only tax-free if it's a qualified distribution, which usually involves meeting the 5-year seasoning rule for the account.
Okay. And here's that first big point you highlighted from the source about inheriting these assets inside the Roth IRA.
Yes. Unlike inheriting, say, stocks or a rental property in a normal taxable account.
Where you usually get that step up in basis to the value on the date of death.
Exactly. That step up wipes out potential capital gains up to that point. But for assets held inside an inherited Roth IRA,
No step up.
no step up upon inheritance. The original cost basis that the IRA had in the asset just carries over inside the account.
Okay, that's fundamental. That sets the stage for what happens when you take it out, right?
Precisely. It makes the distribution event itself really, really important.
So let's talk about that in-kind distribution taking the actual LLC interest out. The tax treatment depends on whether it's qualified.
Correct. If it is a qualified distribution, the whole value coming out the original contribution portion and all the accumulated earnings is tax-free.
Nice. And if it's not qualified,
Then the earnings portion could be taxed as ordinary income and potentially hit with penalties depending on the circumstances.
like taking earnings out before the original owner's 5-year seasoning period was met.
That's a classic example of something that could make the earnings taxable if withdrawn too soon.
Okay, but here's the part you flagged as the real aha moment,
Yeah.
especially for that planned distribution in year 10.
Yes, this is the absolute key takeaway from the source regarding in-kind distributions from an inherited Roth IRA. When you take that asset out,
The LLC interest in the STR.
right, the value that gets reported as distributed from the IRA is the asset's fair market value, the FMV, on the day of the distribution.
Okay, so the distribution amount is its current market value.
But here's the crucial next step. Your new cost basis in that asset, once it's in your hands personally outside the IRA.
My starting point for future taxes.
Exactly. That basis becomes the fair market value on the date of distribution.
Wow. Okay, wait. So not the original $5,000 the IRA put in, not the basis carried over inside the IRA.
Nope. It resets. The moment it leaves the Roth IRA via an in-kind distribution, your basis becomes its current market value.
So if that 3.33% LLC interest is worth, say, $20,000 when it's distributed in year 10, my basis in it is $20,000.
That's how the source explains it. Your basis is reset to the FMV at the time it leaves the account.
That's potentially a huge tax advantage down the line if you eventually sell that interest, right? It wipes out the gain that happened inside the IRA for future capital gains calculation.
It effectively does, yes. It establishes a new, higher starting point for calculating any gains after it's been distributed.
Okay, that FMV basis reset on distribution is massive. Got it. Now, let's layer in those timing rules you mentioned. The Secure Act changed things here.
It did. There are really two key timing rules to juggle. First, that 5-year rule we touched on.
That's for making sure earnings distributions are qualified and tax-free.
Right. And it applies to the original owner's Roth IRA. The clock starts January 1st of the year they first contributed or converted to any Roth IRA. The account needs that 5-year seasoning.
And the important point for me is the beneficiary.
If that original 5-year period has been met by the time you take a distribution, you, the beneficiary, can take out earnings tax-free.
Even if I'm, say, under 59 and a half.
Yes. That's a key benefit for beneficiaries mentioned in the source. The age 59.5 rule for accessing earnings tax-free generally doesn't apply to beneficiaries taking qualified distributions from an inherited Roth IRA as long as the account itself is seasoned.
Okay, good to know. Tax-free earnings access is powerful. Now, the other big rule, the 10-year rule.
Right. This is the major change from the Secure Act for most beneficiaries if you're classified as a non-eligible designated beneficiary.
Which you said includes most adult children, friends, non-relatives.
Correct. For those beneficiaries, the entire balance of the inherited Roth IRA must be fully distributed, completely emptied by the end of the 10th calendar year following the year the original owner died.
10 years to get everything out, period.
That's the rule.
Yeah.
So that planned in-kind distribution of the STR interest in year 10 we talked about.
Has to happen before that deadline hits.
Absolutely. Any funds or assets left after the 10-year mark could face substantial penalties.
And the source mentioned you have flexibility in how you meet that rule within the 10 years.
Yeah, you don't have to distribute assets like kind. You could, for instance, have the IRA sell the LLC interest for cash and distribute the cash. Or you can distribute the LLC interest itself in kind, as long as the full value is out by the deadline.
10 years for most people. But there's a major exception group.
Yes, the eligible designated beneficiaries, or EDBs. They get different treatment.
They don't have to follow the 10-year rule.
Correct. EDBs can instead stretch distributions over their own life expectancy.
Okay, who qualifies as an EDB?
The source lists them out. It includes the surviving spouse of the account owner. They have special options, including treating it as their own IRA.
Right.
Also, minor children of the deceased owner, though importantly, once they reach the age of majority, the 10-year rule typically kicks in for them at that point.
Ah, okay. So the stretch is only while they're minors. Who else?
Individuals classified as disabled or chronically ill. And also, interestingly, any beneficiary who is not more than 10 years younger than the deceased account owner, like a sibling close in age or potentially a partner.
So if you fall into one of those EDB categories, you skip the 10-year clean-out rule. What do you have to do instead?
EDBs using the stretch method must take required minimum distributions, or RMDs, each year, starting the year after the owner's death.
RMDs. Okay, I've heard of those for regular IRAs. How do you calculate it for an inherited stretch?
You take the account balance from the end of the previous year. Then you look up your life expectancy factor in the IRS's single life expectancy table. It's in publication 590B. You find the factor corresponding to your age in the year after the owner died.
And divide the balance by that factor.
Exactly. That's your RMD for the first year. Then, for each subsequent year, the source says you just reduce that life expectancy factor by 1 to calculate the next RMD.
So the example they gave, a 60-year-old EDB inherits $500. Factor is 27.1. First RMD is $500K, 27.1, about $18,450.
Right. And the next year, the divisor would be 26.1, applied to whatever the account balance is then.
This allows the funds to potentially grow tax-advantaged for much, much longer than just 10 years.
Definitely. That's the main benefit of being an EDB.
Okay, so whether you're on the 10-year clock or stretching as an EDB taking RMDs, you still have choices about how and when within those rules you take the money out, right?
Yeah.
The source mentioned strategies.
Yes, you control the pacing within the required time frame. One approach is trying to maximize that tax-free growth.
Just wait until the very end, like year 10.
Yeah, take a lump sum then. The upside is potentially more growth. The downside, market could tank right before you pull it out, or a huge lump sum might affect other benefits or push you into a higher tax bracket if any part was taxable for some reason, though less likely with a Roth.
Makes sense. What else?
You could take equal withdrawals each year. Like if you're on the 10-year rule, maybe take out 10% of the initial value each year.
Pros and cons.
Pro, steady, predictable stream of funds, helps with budgeting. Con, you're pulling money out earlier, so potentially missing some growth compared to waiting.
Okay, any other approaches?
Well, you could try to be strategic based on the market, withdraw more when investments are performing well, maybe hold back, or take less during downturns.
Sounds smart but tricky.
It is. Pro, you might optimize returns. Con, requires you to actively manage and time the market, which is notoriously difficult and risky.
Right, and the last one.
Aligning withdrawals with your actual life needs. Maybe you need a chunk for tuition in year 3 or a down payment in year 7.
So using the funds as needed.
Yeah. Pro, funds are there for major expenses. Con, taking large amounts out early significantly reduces the potential for long-term tax-free growth.
Okay, so different ways to approach the payout phase depending on your situation and goals within either the 10-year or the lifetime RMD framework.
Exactly.
Now, this specific joint venture structure, using an IRA, it's not without potential pitfalls, right? The source mentioned some challenges.
Definitely. 2 big ones stand out, especially related to this STR scenario. First, accurately determining the fair market value, FMV, of that LLC interest.
Which is crucial for that in-kind distribution.
Yeah.
Because the FMV becomes the new basis.
Precisely. Getting that valuation wrong can cause major headaches with the IRS. And valuing a fractional interest in a private LLC holding real estate isn't always straightforward. You'd likely need a qualified appraisal.
Yeah, that sounds like a potential hurdle. What's the other one?
Avoiding prohibited transactions. This is huge when using self-directed IRAs, especially with real estate or closely held businesses.
What are those exactly?
There are specific actions the IRS forbids between the IRA and the IRA owner or other disqualified persons like close family members or businesses they control.
Like what kind of actions?
Things like the IRA owner personally using the STR property for a vacation, or the IRA lending money to the owner, or selling the property to a family member for less than market value. Basically, any self-dealing or improper personal benefit derived from the IRA's assets.
And the consequences are bad.
Very bad. A prohibited transaction can disqualify the entire IRA, treating it as if all the assets were distributed on day 1 of that year, triggering immediate taxes and penalties. It's something you have to be incredibly careful about.
Okay, definitely need to steer clear of those. So let's recap. We've walked through this specific STR joint venture, the funding, the ownership versus a 50-50 income split, that planned in-kind distribution, the sale terms.
We hit the unique basis rules for assets inside an inherited Roth IRA, no step up on death, but that crucial FMV basis reset when distributed in kind.
We clarified the timing. The original owner's 5-year seasoning for tax-free earnings. The big 10-year rule for most beneficiaries to empty the account.
And the exceptions for eligible designated beneficiaries, the EDBs, who can stretch withdrawals over their lifetime using RMDs instead.
And we looked at different ways you might strategize those withdrawals within the rules, plus the key challenges like valuation and avoiding those prohibited transactions.
Yeah, I think what's really fascinating here is seeing how the specific terms you negotiate in a partnership agreement like this.
The unequal capital, the 50-50 income, the 25-75 sales split.
Right, how all that interacts directly with these very specific, complex, but potentially quite advantageous tax rules for inherited Roth IRAs, especially that FMV basis reset and the distribution deadlines.
It really connects the partnership structure to the retirement account tax rules.
Yeah.
So if we zoom out, thinking about the bigger picture here, maybe the final thought for you to consider, how does the exact timing of that planned in-kind distribution in year 10, and therefore the specific fair market value on that day, potentially influence the overall outcome? How does that day's value, which sets your new basis, interact with the 10-year deadline and impact the total tax efficiency and return for both you and your partner compared to, say, liquidating inside the IRA first or taking distributions differently?
That's a great point. The specific FMV on distribution day isn't just a number. It's a critical tax planning event that could significantly shift the long-term economics, especially for calculating gains after the asset leaves the IRA.
Definitely something to weigh carefully as you move forward with this strategy.